Many people believe they can manage their investments on their own. It seems pretty simple. Open a Demat account, follow some YouTubers, take tips from so called TV experts, and invest some or the other mutual fund or stocks, and that's all. But in reality, I have seen this going wrong again and again. DIY or do it yourself investing looks exciting on the surface, but for most people, it leads to capital loss, wasted time, and hence mental stress. In this video, I will share my experiences of why DIY investing fails for most. Number two, who should do it? Number three, who should avoid it? And number four, why having a trusted financial advisor is an essential strategy but not a cost. So, let's start with a truth. DIY or do it yourself investing is not bad. It gives you control, transparency, and flexibility. But the problem starts when people assume that just because they are educated or smart, they can also manage money well. They forget that successful investing is not about intelligence, it's about managing risk, managing behavior, discipline, and consistency. When markets are booming, anyone and everyone looks genius. But it's during bear phases or volatility that most DIY portfolios collapse. And I have seen this firsthand. A special case in 2000 internet bubble burst, 2008 financial crisis, and latest 2020 COVID pandemic. People panic, sell at bottom, or hold on to losers for too long. Some even stop investing altogether, waiting endlessly for that perfect timing. And hence, the real damage is not just money lost, but time lost, and with time, the missed opportunities of compounding. And most painfully, the mental stress, agony, and regret. So, who can succeed at DIY investing? That's the question. Frankly, very few, because the traits required for this are highly demanding, not intellectually, but behavior wise. Here are the qualities that require to be successful as do it yourself investor. Number one, you must have deep knowledge of equity investing. Number two, you have ample time to research, study, and track macro, micro environment, various sectors, economic policies regularly. Number three, you enjoy reading annual reports, balance sheets, and con calls. Number four, you understand asset allocation, risk management, portfolio rebalancing, and your own behavioral biases. 5. You know how to create a goal based portfolio, not just buy individual stocks randomly. 6. You can stay emotionally stable even when your portfolio drops by 50%. 7. And most important aspect is you can take correct decisions under uncertainty. In short, if you are treating investing like a serious profession and not as a hobby, you might be ready for DIY investing. It needs dedicated time, knowledge, curiosity, and hunger to keep learning every day. If you have it in you, go ahead and do on your own. That's the best thing to do. But let's be very honest. Most people don't meet this criteria. So the best thing to do is to avoid investing on your own. Here is a list who all should avoid DIY investing. Number one, busy professionals should avoid DIY investing because you already have demanding careers. Please ask yourself, do you really have spare time for serious research and track markets regularly? You don't. Number two, retirees or defense veterans must not invest on their own because your focus should be peace of mind and not mental stress. 3. People with essential life goals to be met must avoid investing on their own. For example, if your child's education, daughter's marriage, your retirement, or your home depends on stock market investments, then you are in a serious danger. You're not investing, you're gambling with your life. 4. Those who panic during volatility must avoid investing on their own because emotional mistakes are the biggest wealth destroyers. 5. People who don't review or rebalance their portfolio regularly, they must avoid. One bad asset allocation can set you back by years. And here is the truth. Even successful DIY investors burnt out. Managing emotions, market noise, macro events, new rules, policies all take a heavy toll. If you can't handle these, it is wise to seek services of a trusted financial advisor and let him manage your money. At least you will sleep peacefully. A good financial advisor is not just someone who tells you where to invest your money, but when the market starts collapsing, he is your trusted friend, a mentor, and a philosopher. Creating a financial plan to achieve your life goals is just the beginning. Every advisor will do that, but a good advisor goes beyond the basics. He brings these four powerful dimensions to your investing journey. Number one, he manages your behavior. When the market falls, you will want to run. When it rises too fast, you will want to jump in blindly. Your advisor keeps you grounded. He becomes your emotional anchor. Number two, he manages your risk. He protects you from mistakes, bad timing, wrong product, overexposure, under diversification. One error can destroy years of returns. Number three, he simplifies the process. He gives you clarity, filters the noise, and shows you simple path. Number four, and most important one, is that he gives you peace of mind so that you can live your life happily. So, here is my final thought. If you are investing on your own, then it looks tempting, it looks empowering. But without the right knowledge, time, temperament, process, and structure, it often leads to stress and underperformance. Wealth is not just built by chasing returns, wealth is built by avoiding mistake and staying consistent. And that's where an trusted advisor becomes your greatest asset. If you're serious about building wealth and want someone whom you can trust, we are happy to help. Thanks for watching. See you soon. Jai Hind.